Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Omega Healthcare stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Omega Healthcare is a triple net REIT that funds and operates skilled nursing and senior living facilities. Triple net is a lease agreement where the tenant pays all the expenses of the property, including real estate taxes, building insurance, and maintenance. This type of lease provides a secure, steady source of revenue as opposed to a traditional lease. Cash flow is more dependable with this company since the expenses are the operator's responsibility. Also, the company only takes in quality tenants. Its portfolio consists of 949 healthcare facilities in 42 states, also in the UK. The state with the most facilities is Florida, which makes up 15% of its portfolio. This makes sense since there's lots of retirees in Florida. Texas is the second largest state with 10% of the portfolio. The company's specialty is in skilled nursing facilities, or SNFs, which make up 78% of its portfolio. Nursing homes are where people usually go when they require high levels of assistance with non-medical everyday living tasks. SNFs are where people go who require medical care. For example, someone recovering from a stroke. Also, the staff at these facilities have to have proper training so they can safely and effectively perform the necessary tasks. The workers are required to treat, manage, and observe a person's condition. SNFs are primarily funded by Medicare and Medicaid. The company is headquartered in Hunt Valley, Maryland, and was founded in 1992. It started trading in 92 and can be found on the New York Stock Exchange, Deutsche Börse, and London Stock Exchange. Let's get started with the model. This is a mid-cap company, $7 billion market cap. They're trading at $29.51 a share, and they have 239 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They have positive and growing free cash flow each year. It nearly doubles from 2018 to the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's also pretty consistent year to year. Revenue is the sales for the company. That's around $900 million each year. This is the company's income statement. The top line is the revenue, the sales. A bulk of their revenue comes from the rental income from their properties. They also mortgage out some of their properties and receive the mortgage interest from those tenants. That's $89 million. Other investment income are the loans this company makes to its operators, so the healthcare facilities can fund CapEx and working capital. Miscellaneous income are asset manager fees for certain joint ventures. Below revenue are their expenses, and then you have your operating income. Here's a breakdown of all their 2020 expenses from their 10K. So they have lots of depreciation and amortization because they own a lot of real estate, so they're always passing through depreciation expenses. These are non-cash expenses that bring down your net income, but they don't affect cash flow. We'll look at the cash flow from operations section later, and you'll see that's a lot higher than their net income. Examples of G&A expenses are rent and payroll. Then they have real estate taxes, $72 million impairment expense. So sometimes they have to write down the value of its real estate and pass through the loss onto the income statement. And they do take on a lot of debt, so they pay $223 million of interest on their debt. And the bottom line of the income statement is their net income. And you can see they pay very little taxes. That's a big benefit of being a REIT structure is you pay very little in taxes because 90% of your income gets passed on to the investors as a dividend. So REITs avoid double taxation. Let's talk about earnings from equity interest. Usually when a company owns between 20% and 50% of another company, then that company is considered to have significant influence over the company it owns. So OHI has to report the proportional ownership of that company's earnings onto its income statement. The companies they own were profitable. As you can see, there's positive numbers here. But if the companies they own had big losses, you would see negative here. This is called equity method accounting. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash. because net income is your accounting profit or loss. It's not actual cash. So you can see how much more operating cash flow they have than net income. And they usually have something in CapEx because every time they acquire real estate, that goes into CapEx. Operating cash flow minus CapEx gives you your free cash flow. They have lots of free cash flow each year, and it's growing up to over $700 million. Most of the free cash flow is paid out as dividends. That's why they pay so little in taxes. In order for a REIT to grow and buy more properties, it needs to take on debt because there's not extra cash flow to grow the business. But the good thing is they're not really adding any debt. They're rolling their debt. They issue a similar amount of debt each year as they pay down. This is the equity section of their balance sheet. They raised $6.4 billion from selling their business. And I really like they broke out their retained earnings because retained earnings is a sum of all your prior net incomes minus the sum of all the dividends you paid. And here's the sum of all their retained earnings, $2.8 billion, and they paid out $5.2 billion in dividend payments. So they have a cumulative loss of $2.4 billion from running their business historically. You may be thinking, I thought they only paid 90% of their earnings out as dividends. How can they give out so much more in dividends than they earned? Because cumulative earnings is a sum of all your prior net incomes. Net income is artificially low for REITs because of all the depreciation expenses. Look in the trailing 12 months, they had $214 million of net income, but actually generated over $700 million of free cash flow. So if you summed all their prior free cash flows, I bet it would be higher than $5.2 billion. Eventually their earnings will be higher than their dividends paid, especially once they completely depreciate their assets or they sell their assets and pass through a big gain onto the income statement. So a lot of REITs have negative retained earnings for this reason due to the high depreciation. But when you invest in a company, ideally they'd have positive retained earnings. Unless it's a startup, of course it's going to have negative for a while. But if it's a mature company, they can't have negative retained earnings indefinitely. Let's look at the capital structure. $4 billion of equity, $5.3 billion of debt. They're 43% equity, 57% debt. And their weighted average cost of capital is 9%. So on Finbox, they show you the weighted average cost of capital, low, medium, and high. I took the highest. That's the most conservative approach. The higher the WACC, the lower my valuation. The lower the WACC, the higher my valuation. So I'm trying to be really transparent and show you where I get all the numbers. I used to calculate the WACC on my own, but I'm probably going to be pulling it from financial websites so you can recreate these types of videos yourself. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $10 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $9 billion. We divide that by 239 million shares. And we get a calculated stock price of $38. They're trading at $30, so they're trading at a 22% discount. It's a buy according to the model. The average analyst projects their revenue to grow 4.3%. I increased their revenue 4.3% for the next 4 years. That's how I got their future revenue. To get their future free cash flows, I needed to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers and I divided by the sum of these 4 revenue numbers. And that comes out to 59%. So I multiplied their future revenue numbers by 59%. That's how I got their future free cash flows. This definitely seems like something they can achieve because their future free cash flows are all lower than 2020 and the trailing 12 months. 2020 is the same as 2024. That's just a coincidence. Simply Wall Street is way higher than me. They're at $89 a share. They're saying the stock is 67% undervalued. 9 analysts priced this stock and the average price target was $38. This is where the stock has been trading the last 12 months. So it looks like it's pretty flat from 12 months ago. It did come up a lot, but then it came back down. But you are getting that dividend payment each quarter, and it's a pretty good dividend at that. They pay a really nice dividend, 9%. And you can't really look at the payout ratio because their net income is artificially low due to all that depreciation. It's better to look at dividend over free cash flow. And coincidentally, it's 90%. And that's how much REITs have to pay out as dividends, 90%. But it's usually different than 90%. It could be 70%, 110%. But if you looked at it over a long time frame, it would be 90%. But each year would fluctuate due to accounting. And they pay a much higher dividend than their industry. They pay 9%. The industry average is only 3%. And their beta is pretty close to 1, so the stock moves with the market. It's gone down 4% in the past 52 weeks. But if you add the dividend, the stock went up. That's compared to the S&P 500, which went up 27%. The 52-week low was 28, the high was 31, and the stock is trading below its 50-day and 200-day moving average. 2.5 million shares are traded each day on this stock. Pretty much all the shares outstanding are on float. 72% are held by institutions, and 5% of the shares are shorted. Analysts are projecting their earnings to grow less than its industry. Same thing for the revenue, to grow less than its industry. Their employee count seems to be going up. It was 68 at the end of 2020. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $37,000 today. That's a 14% annual return. The biggest shareholder is Vanguard at 14%, then BlackRock, State Street, Invesco, and BNY Mellon. Let's look at their financial ratios. The PE ratio isn't the best ratio to look at when valuing a REIT. It's best to look at price of stock over funds from operations per share. We'll look at that later. But their PE ratio is close to average. Their price to sales ratio is a little high, but it's better than average, and they have a good price to book at 1.8. They have a low return on invested capital, interest coverage ratio of 2, and a low ROE of 5.3%. They have a high current ratio and quick ratio. They have $100 million of cash on their balance sheet and $1.1 billion of receivables. Most of their receivables are notes receivables. This is not like money that's owed from the past. It's not like back rent. When they sign a promissory note with a tenant, in that contract, it may say the tenant needs to pay 9 months of rent at $10,000 per month. So all the future rent payments in that note are part of notes receivables. So they will pay them in the future. So when the tenant pays their monthly rent, they'll reduce notes receivable by that rent amount and increase their cash. They seem to be well capitalized, $700 million of free cash flow into the trailing 12 months, $1 billion of working capital, and they paid out $640 million in dividend payments. So they have over $1 billion of funding. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 7 companies in the same industry as Omega, and if Omega has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So you want to look at the price of stock over funds from operations per share when looking at REITs. Funds from operations is net income plus depreciation or amortization minus the gain on the sale of real estate. And the lower the better for this ratio. They're doing better than average. They're at 10. A lot of these numbers are fairly close to the average, even though they're all red. And they do pay a high dividend, better than their industry. So to summarize, I have them trading at a 22% discount. And REITs are really good investments if you want exposure to high dividend stocks. You won't get big stock price appreciation, but you'll get that consistent dividend payment. And it's a good way to get exposure to real estate as well. So I think it's a pretty safe long-term investment. The company seems to always raise their dividend and have pretty healthy free cash flow. I ranked their free cash flow 8 out of 10, their revenue 7 out of 10, and their ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.